Every time your mortgage rate changes, or a country's cash loses its value, one institution is behind it, and it's not your bank. It's the central bank. It never opens a branch for you, yet it quietly sets the price of money for everyone. Let's see how. Every currency has one institution standing behind it: the Federal Reserve for the dollar, the European Central Bank for the euro, the Bank of England for the pound, the Bank of Japan for the yen. Unlike Chase or HSBC, you can never walk in and open a savings account there. Its only customers are other banks. Job 1. It sets the interest rate that every other rate in the economy, mortgages, savings, business loans, is built on top of. Job 2. It controls how much money exists in the first place, literally how many dollars, euros, or yen are circulating in the economy at all. Job 3. When a healthy bank suddenly runs short of cash, it can be the only lender willing to step in overnight and stop a panic from spreading. You've probably heard these names on the news dozens of times without ever hearing what they actually control day to day. 3 jobs, 1 quiet institution, and almost every price you see in the economy traces back to it somehow. Picture a single dial that sets the price of borrowing for an entire economy. Turn it up, and every loan gets more expensive almost overnight. From early 2022 to mid-2023, the U.S. Federal Reserve turned the dial from near zero all the way past 5%, the fastest series of hikes in over 40 years. The European Central Bank did almost the same thing, moving from minus 0.5% to 4% in about a year. That single number doesn't stay in a boardroom. It ripples outward into almost every corner of daily life. A 30-year, $300,000 mortgage at 3% costs about $1,265 a month. At 7%, that jumps to nearly $2,000 for the exact same loan. Savers finally benefit too. Ordinary savings accounts started paying real interest again after more than a decade of almost nothing. Businesses feel it as well. A new factory or store that made sense to build at 3% interest often doesn't pencil out anymore at 7%. Even the currency itself moves. Higher rates attract savers from abroad chasing a better return, which tends to push the currency stronger. Credit cards and car loans move too. The average new car loan rate went from around 4% to nearly 8% in the same stretch of time. Before the 2008 crisis, the Fed's balance sheet, basically everything it owns, was about $0.9 trillion. After 2008, it launched quantitative easing, buying government bonds from banks and paying for them by simply crediting each bank's account with brand new electronic reserves. By the mid-2010s, that pushed the balance sheet to about $4.5 trillion. It's not printing paper cash, it's new money that only exists as numbers in a bank's account. Then 2020 hit, and it did the same thing again, even faster. Within 2 years, the balance sheet reached almost $9 trillion, the fastest expansion in the Fed's history. All that new money flooding the system is a big part of why inflation took off in 2021 and 2022, which is exactly why the next move had to be the opposite one. Starting in 2022, the Fed reversed course, quantitative tightening. It let bonds mature without buying new ones, quietly shrinking the balance sheet back down to about $7.3 trillion. Growing and shrinking that balance sheet is the closest thing to a money supply lever the modern economy has. The European Central Bank and the Bank of Japan ran almost the exact same playbook on their own currencies, just with different numbers and different timing. September 2007. A British bank, Northern Rock, needed emergency funding from the Bank of England. The announcement, meant to reassure everyone, did the exact opposite. For the first time in over 100 years, people in Britain queued outside a bank branch to pull their money out in person. In just 3 days, customers withdrew more than £1 billion. No bank, anywhere, keeps that much spare cash sitting around. That's exactly the moment a central bank exists for. The Bank of England stepped in and lent Northern Rock emergency money overnight, so it could keep paying depositors. This isn't improvised. There's an actual rule for it, over 150 years old, from the economist Walter Bagehot: lend freely, against good collateral, at a high rate. Freely, so the panic actually stops. Against good collateral, so the loan is safe. At a high rate, so it's a bridge over a bad week, never a cheap bailout. You'll see this exact playbook again and again, decades apart, whenever an otherwise healthy bank hits a sudden cash crunch. This is different from deposit insurance, which protects small savers directly. The central bank's job is to stop the whole banking system from freezing up at once. Here's the one job a central bank has to be allowed to say no to a president or prime minister for: keeping inflation under control. Every economy starts from the same place. In 2021, Turkey's central bank faced a choice familiar to every central bank on earth: raise rates or don't. Left alone to raise rates when inflation rises, the path usually looks like this: bumpy, but coming back down. That's roughly what most independent central banks did through 2022 and 2023. But Turkey's president pushed his central bank to cut rates instead, arguing lower rates would fight inflation economically. That's backwards. Inflation shot past 80% by late 2022, and the lira lost more than half its value against the dollar in 2 years. It's an old lesson. Weimar Germany in the 1920s, Zimbabwe in the 2000s, same root cause: a leader with control over the money printer, and prices spiral. That's exactly why almost every modern economy legally protects its central bank from day-to-day political control, even when a rate hike is deeply unpopular right before an election. So next time you see a government pressuring its central bank, or a headline about a currency in free fall, you'll know exactly which wire got crossed. Independence isn't red tape. It's the guardrail standing between your money and someone else's political ambitions. Interest rates, the money supply, and a safety net for banks in a panic: that's the whole job, boiled down. Next time your mortgage payment changes, or a currency crashes somewhere in the world, you'll know exactly who's behind it.